You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing.
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning in to the Millionacres Podcast. Today, I'm talking to Michael Episcope, one of the co-founders of Origin Investments. Founded in 2007, Origin Investments is a real estate investment firm that acquires multifamily properties in a lot of the fastest growing markets that we've been talking about lately, like Atlanta, Austin, Charlotte, Denver, Raleigh. It's raised multiple funds for investors. And so we're going to talk today about real estate investing, about the current market, about the multifamily boom, and so much more. Welcome, Michael.
Thank you for having me, Deidre.
Let's get right into it. So your primary investing thesis, as I understand it, is about multifamily in some of the fastest growing markets. That's definitely one of our investing thesis investment things that we think about with our premium services, Mogul, and things like that. What are you seeing right now in the multifamily space?
So a lot. I mean, certainly with COVID having happened last year and a lot of the demographic shifts going on, you're starting to see the migration changes that really started last year. But I'll caveat this by saying two things. You had a lot of one-way, or what we thought were one-way moving trucks going down to the Sun Belt markets, and we think that this trend is going to prevail for definitely the next decade. And this has been happening, that the northern cities have been losing population to the Sun Belt, southern cities for quite some time, especially the high-tax cities going to the low-tax cities. And COVID only accelerated that trend that we've seen. So we've been in these markets, certainly before COVID. These were the fastest growing markets pre-COVID. Low taxes, affordability, just areas that are truly lifestyle markets where people want to live and work. Those are the areas that have been benefiting for the last 10 years, and COVID only accelerated that. So what's interesting, though, is we've also seen what we thought were those one-way moving trucks. They're not one-way. They're coming back. So we've seen a lot of strength in the northern cities as well. And, you know, as we're looking at sort of the overall growth of the market and the demographics and everything going out there, there's a housing shortage both on the for sale and the multifamily side in many of the markets we're in. And but it's interesting to see kind of strength everywhere as we're looking around.
Interesting. Wanted to ask you about types of multifamily, because one of the things I'm seeing a lot right now is that garden style apartments, smaller communities, those are selling well. They're also commanding higher rents. It seems like some of the really high towers are not doing as well. Is that something that you're keeping an eye on?
Yeah, 100%. So we focus primarily in garden style apartments, and it's really for that affordability component of it, as you sort of mentioned. And the reason why, when you're building high rise and podium, the cost to construct those projects is so much higher that you really need rents that are approaching mid $2 per square foot, $3 per square foot, and it prices so many people. The air gets really thin up there. But when you're looking at garden style apartments, especially in some of these markets, even as you factor in some of the cost increases that have happened across the market in the last few years, we can still deliver apartments at what we call affordable prices. So, you know, the apartments today are much different than they were 3, 5, even 10 years ago. They're shrinking, where the average unit used to be about 900 square feet in size. Today, they're 750. So your units are getting smaller, but your chunk price, which is the most important thing, how much you're paying in rent, is staying about the same. So when we're looking at our markets, I would say that brand new product, garden and wrap is what we're really focusing on, but that affordability component to it, we're able to deliver in the market about $1.40 per square foot to all the way up to about $1.75, $1.80. So we're really looking to hit that bulk of the market where people who are making $60,000, $70,000, $80,000 can afford a beautiful Class A apartment unit in a nice community. And that's really, I think, where the crux of the market and where a lot of the deliveries are going to be happening in a lot of these Sunbelt states, especially with this migration happening.
Absolutely. So the projects you're looking at, are they mostly value add, core, or opportunistic?
So no, and I was going to say that in the beginning. So what we're seeing, we're focusing on building and lending in the market. And our three strategies are really building, buying, and lending. The challenge in today's market, and one of the things that we've really been keeping an eye on, is that you had a tremendous amount of pent-up demand in 2020. People who wanted to invest, a lot of funds out there that couldn't invest, and they're all investing in 2021, and a lot of them are chasing momentum down into these Sunbelt, these southern markets, and the Austins, the Nashvilles, the Tampas of the world. And what's happening is you're getting older product that is just trading well above replacement cost. So to us, we're kind of stepping back a little bit, and even though we have those three sort of strategies of building, buying, and lending, it's more of a barbell today. So we're choosing to build and lend and staying out of that middle portion of the value add, because if we can build a brand new product for, let's say, $220,000 per unit, and that's going to be delivered in 2 years, that's a much smarter move for us and our investors than buying something that's 12 years old that we have to value add, that we will be into for $250,000, $260,000 per unit when we are done. So it's really, a lot of people see development as a more risky proposition. We actually see it as a lower risk proposition in today's market, because you're still able to get that spread between the cost of development and the market value. So if these value add buyers are correct in today's market and it continues to go up, the spreads on development will only get better. So it's just a matter of how do you want to enter the market in an already built project that you're paying above replacement cost, or do you want to do it by building brand new? And so for us, it makes a lot more sense to build. And it's also, there's so much capital in the markets right now that to compete and go to the bidding process, you might get 20 to 25 buyers. And that's just not how we want to compete. So we swim upstream. We're willing to go where others aren't. To gain penetration in some of these markets, it just makes a lot more sense to build and compete against all the hot money that's out there.
That's really interesting, because I think you mentioned something really important there, which is there is so much capital. I'm just seeing transactions left and right, and I know some people have to be buying for more than they should be. So in terms of the building and the lending and that strategy, is that a buy market strategy or more of a buy project strategy?
So the 14 markets that we cover, we utilize those three strategies in every market. So we like to think of ourselves as a solution to the market. Our model is more of a joint venture model. So we're working with sponsors on the ground. And whether they are selling a deal, whether they need capitalization for ground up development that they've been working on for 2 years. And a lot of times if we can't meet terms on the equity side, then what we do is we talk about, okay, well, if our equity doesn't work for you and the cost of our equity, and sometimes it doesn't, what about a preferred equity loan? And almost all of our deals that we're lending to are deals that we want to do common equity on as well. So I would say 90% of our preferred equity loans are in ground up development, but in deals we really believe in, with sponsors who we believe in, and in markets we know. So it's not as if we're lending to certain markets or certain product types and we're buying certain product types. Everything we do is really in the Class A garden and wrap multifamily in our 14 target markets. Now, I will say that those markets are always moving and evolving, and we're looking at the data and information, because Chicago, for example, where we're located today, this was a market that 7 or 8 or 9 years ago we were heavily investing in, but it was a very different time. And today, you can't ignore the fiscal situation in Chicago. And with taxes going up and what's happening from kind of a political situation, it's very hard to make sense of investing here when you have more of a national view. I'm not saying Chicago's bad, it's just you have to rank your cities and look at them and make choices based on your capital. So if we have the choice between developing a property in Phoenix or Nashville or Chicago, Phoenix and Nashville are going to win all day long because the fundamentals and the runway for the next 5, 10, 15 years is so much better than the unknowns in Chicago. Now, I've said I love Chicago. I live here. My family's here. I raise kids here. But my investment dollars are elsewhere.
Interesting. So about finding sponsors, what are you looking for? Are sponsors approaching you with deals? Are you sort of just active players in the markets that you're invested in? How does that part of it work?
So we have 4 deal officers in the market. And the way our model is set up is that we're headquartered in Chicago, but then we have offices in Denver. We have an office in Nashville. We have an office in Dallas, and we have an office in Charlotte. And those serve as regional hubs. And it's our deal officers out there who are creating relationships with sponsors, proactively going out there, building relationships. And this market really is about people and who you know. So we're not looking to be transactional. We're looking for long-term relationships with repeat partners. Because when you're in this business long enough, what you realize is that deals that go bad are not about the deal or the real estate or the time. It's about the people who you invest with. And that's the biggest thing. So when you can have a good partnership and find people to do repeat, if things do go wrong and you're both reasonable and like-minded and you can work through these problems together, you can get to the other side intact. If you end up doing a deal with a bad partner, no matter what happens to the market, that takes, that things can just go awry on those sides. So a lot of our time is spent really building those long-term relationships, repeat, getting to know people, understanding their track record. And that's kind of how we've always believed, even with our investment partners to us and us to our sponsor partners on the ground as well. It's just building long-term relationships, and that's what matters in this business. It's about people.
Totally agree with that. It's one of the things we've noticed inside our mogul service is that sponsor communication is pretty much everything, and track record and all of that stuff really matters when you're talking about investments. Well, I know that Origin is for accredited investors so far. We've seen the SEC make some changes in opening up the rules for accreditation. How closely are you watching that? Are you ever thinking of going into other options for investors, like having like a Reg A plus or anything like that?
Today we serve about 1,800 investment partners. So there we have quite a bit. And we've talked about how do we scale up our organization to lower our minimums, because today we're operating 4 funds, and one of them is actually for qualified purchasers only, because that's a credit fund and there's securities in it, and that's our multifamily credit fund. It is real estate backed loans on that side. But our other funds, our QZ fund, that has a minimum of $50,000, and then our Income Plus fund has a minimum of $100,000. So we're not talking about opening up a Reg A plus fund. I don't want to complicate matters, but if we can serve the needs of more accredited investors by lowering our minimum and figuring out how to scale, that's a conversation that's been ongoing for a long time. But it really takes a technological solution. I think we're there today. There's some things that we have to straighten out. We just got onto a new system recently. It seems to be going quite well. And then in the future, if we can find a way to be sort of lower touch, if you will, on investors who want to put in $10,000, $20,000, $30,000, we'd absolutely love to do that. But really our model is a high touch model. Today we have 8 people in our investor relations group, which is probably bigger than any other IR group out there for a company our size, even 10 times as big as us. And it's that personal relationship and having that contact that matters so much. And we don't want to necessarily lose that, but we also want to be able to share our funds with the people who need them most. Because early on, when my partner and I, when we started this company, it was really about building an institutional platform for the high net worth investor, giving them all the benefits of real estate, but with using sort of all the institutional traits. And what I mean by that is the service, what I just talked about, are the fees, right? Keeping the fees at a minimum, and also delivering returns. And we've been able to do that in our fund. So there's nothing more that we like than to bring the minimums down to even service a bigger swath of people out there. So it's been fantastic. We're adding about, I would say, 50 new investors every month, and certainly raising a lot of capital. But there's always that challenge between raising capital, the demand on that side, and prudently investing it in deals. So like right now in our Income Plus fund, we actually just started creating a queue because we have too much cash in there to put out. And so once we are able to invest that over the next few months, we'll open up that queue and let that money back in. And we also just closed down our QOZ Fund 1. We topped it off at around $270 million for the same reason. We had a tremendous amount of demand for our QOZ, and looking at our pipeline, we actually cut off the funding last month. So we'll be opening up QOZ Fund 2 in probably the next 30 to 45 days, as soon as the pipeline builds up enough to make sense of that.
Oh, that's fantastic. So obviously dealing with high net worth individuals, I'm sure one of the biggest questions you get is about taxes. I've noticed that inside our services, investors want to use that SDIRA capital. It seems like you're doing that at Origin Investments. How does that process work for your investors?
So I'll just talk about taxes in general, how we view them. So think about our entire base is the taxable investor. So every single product that we think about and how we structure them, and I'll talk about the evolution here a little bit. So when we started in this business, our Fund 1, 2, and 3 were all closed-ended funds, meaning we raised a committed amount of capital, we found deals, we called that capital, it was a buy, fix, and sell model. And the challenge with that is that when you look at things over time, like real estate is no different than stocks, right? The key to getting wealthy is buy great real estate, buy great stocks, and hold them forever. Because you never know how the upside is going to take care of itself. All you have to do is put yourself in a position to win in the long run. And when I look back at Fund 1, we did extremely well. That was a top decile performing fund. But some of the deals that we sold, you look at them and they've doubled in value. And the same thing in Fund 2. And you look at those and the ones we've sold, now we generated great IRR. But also what you realize is that from talking to investors, they're like, hey, that's awesome. What do I do with my money now? And so our new evolution of funds is really looking at how do we build a better structure and a better fund. And it's looking at how do endowments invest? How do pension funds? How do the most sophisticated family offices invest? Well, they invest by really having a tax strategy around their investment strategy. And so all of our new funds are really buy, fix, and hold, with the option for the investor to get out on an appraisal-based NAV. So when we're thinking about QOZ, Qualified Opportunity Zone, that is an absolute that is a development fund that is all about tax strategy and saving on money on the back end. I'm sure we'll get into it a little bit. Income Plus Fund is an open-ended fund where we're doing development and we're doing lending within that fund. We own some properties as well, but that is an appraisal-based NAV fund where investors can get out when they want to, but it's not us actually selling properties. If we do sell a property in the fund, we can actually 1031 exchange it underneath to save taxes. So, I'm a taxable investor. My partner is a taxable investor. We've invested more than any investor in our funds. And so this is like, we're always looking through things through our lens and how do we want to manage our own money. And tax strategy has to be part of any investment strategy. And our funds have sort of evolved. And even one of our funds coming out, it's a pure multifamily development fund called Growth Fund 4, and we're going to be launching this next month. It'll have about 10 different development deals diversified around the country, and it'll have a short time horizon of about 5 years. But if you want to stay in, you can. If you want to punch out after 5 years, you can, right? So if you're a growth investor and are after IRR and want to maximize it, that 5-year punch out period is for you. But what we found is most people are like, look, after I take the risk with my capital, I just want to enjoy the passive tax-friendly income for a long time. And that's how we've evolved, by listening to our investment partners, but also just managing these around our own capital. And it makes sense. And I really wish more sponsors would think about long-term wealth creation than rather generating short-term IRR, because I think that's a huge mistake that both sponsors focus on and also investors as well. Because if you make 10% a year on all your money for 10 years, that's way better than if you make 15% IRR, you can't measure the wealth creation of that because of the time base of money. You can't spend IRR, is the famous saying in our market. So it's really an educational process, but something we firmly believe in. And Deidre, I hope that answers your question.
It does. It actually, I find it really fascinating because I think you hit on something that we've talked about internally, which is that for real estate crowdfunding, so much focus is put on IRR as what people should be looking for, and people kind of respond to an IRR rate before they even really look at all of the components of a deal. And what you're talking about, I think, is how you get past that and how you think about not just what your returns are going to be, but what the goal actually is of the money you're putting in and how you want that money to be returned to you, and having options about that, I think, is important.
Yeah, and I would go further. It's the after-tax return. And what people don't measure is they compare. So our Income Plus fund, for example, it's a 9 to 11% annualized return. And it doesn't jump off the page, but the term I use, annualized return, is very different than IRR, and yet they look exactly the same. So if somebody invests in our fund, they're being diversified, all of their money is going in at once, and they're generating that return from day one. If you invest in a deal, or if you invest in a called capital fund, you have to also look at the impact of the taxes at the end when that deal gets sold. You have to look at the impact of cash drag, your money sitting around, the rest of your capital not being invested to try to build this portfolio. And so many people don't see sort of that macro view of how they're managing their money. They're just looking at, this one's at 15%, that one's at 10%, this one must be better. And there's an education process. And I've actually written a lot on this about the difference between IRR and annualized yield, and just how to really use multiple on equity to equate the two and look at it. Like, what is your end goal? And as a taxable investor, you have to kind of start thinking about these things. And somebody told me, a long time ago, look, somebody's going to give me 12% on my money, just don't ever pay me back. Just keep it coming. And that's so true. Like, I don't want 15% IRR for 4 months on my money and to play that game. That doesn't work. So again, this has been an evolution, but it's fantastic. And I think our investors really have come to appreciate it. And that's why we've been able to attract so many family offices and high net worth to our platform, because we're doing it differently.
Interesting, because it makes me think also about individual deals. I know, especially if you're dealing with ground up, you have the passive losses, and then you sort of have to use passive losses from one deal to offset another deal when a deal comes through. So you're sort of playing that game all of the time, and that's a lot for the individual investor to think about and try to manage to make sure that they don't have that big tax wallop when a deal ends.
Yeah, and in turn, I'm a much bigger fan of investing in funds, and I don't, we didn't create funds because they're better for us. We actually think they're better for the investor. And the rest of my portfolio, I only invest with managers in a fund, because for me to think that I can pick deals and I can see, or find better deals than they can, that's just ludicrous. And so what I have done, though, is I'll invest with a manager, and if there's a sidecar opportunity, I might invest in that as well. And that's the same way we operate, is that sidecar opportunities that have been vetted by us, that have been screened, that have been underwritten. And it's fantastic because a lot of our investors have been with us so long that when they see a sidecar opportunity, they'll just make a commitment. They don't need a call. They've seen it. They've witnessed, what we can do over and over and over. And we've just built trust over the years with a big group of investment partners. So it's been fantastic just watching this evolve, because you don't build trust overnight in any financial business.
Excellent. Well, let's take a quick break here, and then we will talk about opportunity zones when we return.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors, or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure, they can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt.
I'm back with Michael Episcope of Origin Investments. We're talking about CRE, we're talking about real estate investing, we're going to talk about opportunity zones. But first, I wanted to ask you a little bit about your personal journey, because I think it's kind of interesting. You were a successful trader. You moved over into real estate. You've sort of built this company as a thing, it sounds like, as a thing that you wanted to have in your own life. And so I wanted to ask you about how investors who love stocks, want to have a stock portfolio, but also want to have real estate investments should kind of think about bringing both into their lives.
Yeah, that's a lot of. So I'll start with sort of the background question, and I'll take you back. So this is my second career. I was a commodity trader in my first career, and that is where I built my wealth. And I retired from that career in about 2005, right around 2006, and I knew I wanted to get out of that business and do something else. I just wanted to transition. I'd been in that business since I was 19 years old, and it was time. And I'd always loved real estate. I was exposed to it as a young kid. When I was 12, 13, 14, I used to go work with one of my really good friends, literally building garages, swinging hammers, helping his dad. I was just, labor, but it was fun. And that's what we used to do in our summers. And then my grandfather was in real estate, so I used to go to his buildings, and he was in multifamily, really kind of rough stuff on the west side of Chicago, and I saw the lifestyle that it afforded and what he did, but also how to do it right, and from managing the pennies and the nickels and the dimes and being hands-on it and stuff. And so I think that got into my system at a very young age. But it was really when I retired from trading, I needed to take my assets and turn them into income. And as I was investing out there, even during my trading career, it always felt like 2 steps forward, 1 step back. And I had some good success in real estate, but I had a couple deals that literally just blew up. And it wasn't they blew up. There's the difference between making a bad decision or having a bad vintage, right? 2008 was bad for everybody, and then it was just making stupid mistakes, right? Because you have good decisions that can lead to bad outcomes, and you have bad decisions that can lead to good or bad outcomes. Well, there were a couple of decisions that were both bad decisions and bad outcome. And I just realized at that time that I needed to educate myself. I needed to take control, and there was nobody who was going to be a steward of my money more than I was going to be. So I went back. I got a master's in real estate from DePaul University. I enrolled in 2006. I was sort of the old man in class, if you will. I was about 35, 36 at that time. It's kind of interesting looking back. And my partner and I, we had a very similar background and need. And he was also a high net worth investor. We were working on a nonprofit together. I'd known him for 5 or 6 years. We were just like-minded creatures. And so we decided to start Origin together in 2007 as a means of investing our own capital. I wish I could sit here today and tell you that we had this vision of what it's going to be today, but the reason and the purpose of why we started it is sort of the same. And then we wanted to share that with our friends, our family, and have a platform where people could get to could realize the full benefits of real estate. And you got to understand, this is pre-Jobs Act. So when I'm talking about a world before there were before there was this proliferation of real estate companies and all this transparency in the market. So prior to that, these were all closed door meetings. These were all individual syndications. You couldn't really do a lot of due diligence or compare deals to the market. So a lot of the non-traded private REITs were out there just, charging enormous fees. And we were sort of like, God, there's got to be something better. And so we set out to build it. And that's really what we did in those early stages. And then it was only in about 2014 or 15 that we started to use marketing as a means of attracting new investment partners to our platform, because by the time 2014 and 15 rolled around, we had already been through Fund 1. We had round-tripped it. That was a top decile fund. Fund 2 was shaping up to be top decile. And we said, look, we have a great product. All we have to do is get it in front of a lot of people and they'll buy it. And so that was the simple thesis. And staying true to our sort of philosophy, what we believed in, building the team, building the operations around this, and being an investor in our funds, and that alignment, I think, is what attracted so many people to our organization. And one thing that my partner and I, we talk about a lot is risk management. And we view this in such a comprehensive way in everything we do. And it's not just about the deals we buy and how we manage them and how we capitalize them, but it's also about how our team and how we compensate them and how we keep them, and all of the structures that you can think about aligning people together. And so that is the genesis of sort of how we grow and the ethos of Origin. And that message is still true today. And so our goal as a firm is always to generate returns in the top quartile, the top decile. And what was really, I think, one of the metrics I'm most proud of is that we were just ranked recently as a top 1% manager by Preqin. And we found out from one of our investment partners. And we always ask the question, well, how'd you hear about us? And they said, well, we were actually doing a manager rank in Preqin, and you came up as number 15 out of 2,000. And we said, oh my God, and we subscribe to Preqin and we give them our data and information. So we went in there and took a look at it, and we ran the queries and talked to Preqin, and sure enough, there we were. So, and it's that consistency over time that has really helped us. And that's, we don't want to grow for the sake of growing, but we want to grow in a responsible way to continue to generate those same returns, the same level of service, or even better, because we're an organization that wants to win, and that we want to continue to put out the best product we can in the market.
Interesting. So would you say that most of the investors that come to you already have an interest in real estate, or do they have an existing investment, maybe stock portfolio, and they want to get into real estate? What's their level of knowledge?
Yes, that was sort of your second question about the investor's portfolio. So thank you. Most investors, because what we don't want people to do is call us up and say, tell us about real estate. So if you go to our website, we have more than 400 pieces of original content. We believe strongly in educating and for people to do the research and for people to understand what we're doing. So by the time they have a call with somebody in our Origin or our investor relations department, they've done their homework. And we like investors to come in educated, understanding, knowing a little bit. But if it's their first time investing in real estate, we will hold their hand through that process, because it's very different than pushing a button at Schwab or TD Ameritrade or calling your wealth manager. And real estate really should be part of everyone's portfolio out there, whether it's 5% or 30%, that's up to you to decide, but it's too good of an asset class and it has performed too well to ignore it. So whether it's public REITs or private real estate or a combination of both, real estate belongs in every portfolio out there.
Yeah, I would definitely agree with that. So let's get into opportunity zones. I think it's the question that I get all the time. People got very excited about the tax breaks. We saw so much activity in the beginning. The rules have now, there's as things change, as things evolve, the rules and the benefits are shifting. Who knows what's going to come next with some of the legislation? What are you thinking now about that? And you mentioned earlier, it sounds like you already have a lot of people interested in a second Opportunity Zone fund.
Yeah, well, opportunity zones, I think it's the greatest gift to real estate investors in 50 years because of the tax benefits. So you take something that's already tax efficient and you add on these benefits to the QOZ. And Deidre, I'm assuming the listeners have a basic understanding of what qualified opportunity zones are and the benefits. Do you want me to go over that at all?
Yeah, let's go over it quickly.
Okay, so quickly, 3 benefits to qualified opportunity zone investing, and one of them disappears this year. So the first one, if you have a capital gain from any source out there, whether you sold art, whether you sold your home, whether you sold stocks, bonds, it doesn't matter. If that shows up on your tax return as a capital gain, whether it's short or long term, you can invest that money into a qualified opportunity zone project or fund. You get what's first called a 10% step up in basis if you invest in 2021. To make the math simple, if it's $1 million that you're investing, then you will only recognize $900,000 when you go to pay taxes. The next benefit is when you pay the taxes. Your tax, instead of it being owed or payable next year when you go to pay your taxes, you won't pay that until tax year 2026, payable in 2027. So you get basically an interest-free loan from the government. But the last benefit, which is the most important and the most beneficial, if you hold on to your investment for 10 years in one day, you pay 0 taxes. So if that $1 million becomes worth $2 million, $3 million, $5 million, $8 million, it doesn't matter. Once you take that out at 10 years in a day or 20 years, however long you want to stay into the program, you pay 0 taxes. So you also get depreciation the whole time. You get the advantage of refinancing proceeds tax-free. So it's taking, again, an already tax-efficient investment and just supercharging it even more. And it's something that I personally have been pushing as much money as I can into, and so is my partner.
Well, the other thing about Opportunity Zones, too, is they were designed as this project to encourage investment in areas that were economically depressed. And there's been a lot of criticism about how it's been used, about it being in urban areas versus rural areas, and a little bit of talk about how it's going to change. Are you involved in sort of keeping track of some of what's happening with Opportunity Zone potential legislation or things like that?
So we're keeping track, but there's not much we can do about it now, and we're not lobbying or doing anything on that side. So I'll tell you, there has been a lot of controversy around it because the qualified opportunity zones, they're low to moderate income zones. They're actually, this goes way back, all the way to the Obama days, trying to get this passed into some sort of legislation. The nice thing is it was bipartisan, accepted by both Republicans and Democrats, so we're not worried about this going through. But the big caveat to this is that the zones are based on the 2010 census tracts. So if anybody thinks about the world in 2010 versus where it is 11 years later, some of these cities look totally different. If you went to downtown Denver 10 years ago, that city looks completely different than it does today. Nashville, the same thing. And there's been a lot of urbanization that has happened. So the thing about this, though, is the program, in the way it was designed, it wasn't designed in a way that the money would have ever found its way into the truly blighted neighborhoods, because the benefits happen on the back end for investors once they make a profit. So for a company like ours, we're sort of fishing along the edges, looking at the transitional areas, looking at areas that we would invest anyway, because our primary responsibility is to make a profit for our investors. And so we don't look at a qualified opportunity zone any different than we would a normal development deal. And when we're talking about, we just tied up a deal in Nashville, and it's one of the best development sites in the country. Not the best QOZ sites in the country, it's just hands down. And when we're competing, when we're talking to sponsors out there about a QOZ site, we're not competing with other QOZ capital. We're generally competing with the institutions and market rate capital out there. So, for us, we know we're doing something right because this is market rate capital. But what qualified opportunity zone, what the law doesn't do, it doesn't supplement the capital structure so that we can go into an area that otherwise we couldn't build and build and charge less rents and get less money in revenue. All we would do is lose money. So there are some flaws in the program. I think the most notable change that will come in the next kind of 6 months to a year is they will update this to the 2020 census, which we're looking forward to. The 2020 census is probably more likely. We don't know what that cutoff line, what that transition will be. But given the fact that the 2020 census was just finalized, it makes a lot of sense. So we're keeping an eye on that. And that'll be more true for Fund 2 that we're going to be launching in a month than it is for Fund 1, which we just closed.
Well, I love that you said that you look at a QOZ deal the same way that you would look at any other deal, because I think that's really important. It's one of the things that we've talked about on Million Acres, and it's very important because I think sometimes people just go into an opportunity zone deal. But I wanted to ask if there's any other tax credits that you implement, because you're doing multifamily. Are you looking at low-income housing tax credits or anything like that? Any other programs?
So we're not looking at low-income housing tax credits, but certainly within some of the qualified opportunity zone areas. And I'll give you an example. So we're breaking ground on 2 deals in Colorado Springs, one of my favorite markets. We're joint venturing with Greystar on these deals. And we are getting the equivalent of what I'll call tax increment financing. So a subsidy on our taxes on those projects. And one has a 75% abatement, which essentially means that if our tax bill were going to be $400,000, we're only going to be paying $100,000 for 20 years. And then on the other one, we're getting a 65% abatement. And what happens in these municipalities is that in order to attract new development to the area, they provide these TIF incentives to make the economics work. And you can see from our first project, we were at 75%. Our next project is at 65%. This will go down to 50%, and then it'll go to 0. Because as you build multifamily in these communities, the community actually benefits. It gets better. It attracts more development. So the early adopters, the innovators who are coming into the market, generally get tax subsidies like this, but you're also taking a little bit more risk. In Colorado Springs, this is a great benefit to the deal, our investors, but we're not looking at any other tax subsidies, because low-income housing tax credits and affordable housing is it's just a very different animal than market rate housing that we're building. So those are a lot of government tax credits that's way above my pay level, and we don't do that.
Well, I have to agree with you about Colorado Springs. I recently interviewed a developer there, and he was talking about some of the jobs, some of the aerospace technology and things like that in the area. It's really fascinating market to be involved in.
Well, it is, and I just read an article the other day. It's the #1 housing market for sale housing in the United States, and they measure that by the number of days a home is on the market, and these homes are being snapped up like this. I mean, we fell in love with the market because Colorado Springs is about an hour south of Denver. Denver is experiencing growing pains. It has the job market that you're talking about. It is home to the Front Range. You can actually get to some of the mountain areas quicker, much quicker from Colorado Springs than Denver these days. And the biggest thing that has happened, though, is the government there and sort of the view on development has changed. And so once that happens, like these changes happen really quickly. And this happened in Nashville, and I went back there. I was there about 8 years ago, visited it. You could stand on one side of the gulch and look clear across to the other side of the gulch. And I was just there 6 months ago when I was coming up from my son from Florida, and we drove through and stopped. Buildings everywhere. It looked like downtown Denver. And these things, the development just really feeds on itself in these markets. So we're excited to be down there. We're actually looking for more deals. And where I was going with that story, the government, as it was explained to me, was sort of a weak form of government, a city council. They actually didn't have a mayor. And about 7 years ago, they went to a strong form of government and put a mayor in place so that they could make some of these decisions. And they went from being an anti-development community to a pro-development community. And we've seen that happen in areas of other cities. And once that pendulum flips, things happen fast. So we're excited, and we're going to be keeping an eye on Colorado Springs and making more investments down there.
I love it. Okay, I want to ask you about some of the economic drivers that I think everyone's worried about right now. You've got a couple. You've got potential interest rates rising. You've got potential for high inflation. commodity prices, we've seen lumber up and down, steel has been going up. How are you looking at all of those different things when you're talking about both building and also lending?
So good question. And I'll say this in two ways. Number one, I don't have a crystal ball any better than anybody else does. But with prudent risk management practices, and I'd like to say that we've been thinking about higher interest rates for the last 10, 12, 14 years since we started. And you have to in this business because you have to look at where can you get hurt. And then how do you mitigate that? So when we're doing underwriting, I'll just share with you maybe some of the best practices, institutional practices, and whether people are looking at our deals or other deals, they should look at these things, right? And so what are the variables that move the model the most? Well, growth rate, cap rates, those two variables will probably move your model the most. So when we're looking at a market, we want to be realistic about what we can do, whether it's a value add or whether it's a ground up development. Lending is a little bit different of an animal. You have some protection because of the developer's equity, and you're also investing with a very qualified sponsor. So on top of that, you have the developer profit to fall back on. So I'll focus on value add and ground up development. You want to make sure that your growth rates are incredibly conservative, right? So if you believe that the market is going to grow at 6%, if you put 6% in your model, any model is going to work with a 6% growth rate. And the problem is that's pricing it to perfection. So everybody should look at what is the growth rate of income over the hold period. And generally that should be anywhere between, I would say, 2 and 4%. And we use our own proprietary machine learning predictive model to factor in these rent growths, but we also put a governor on it. So even if the model came back with 7% rent growth, we're not going to put that into our model. We're going to be a little conservative. The next thing that we do is when it comes to interest rates, the best predictor is the forward curve on interest rates. So we plug those in and look at that. And if there are exogenous shocks, we do stress tests, things of that nature. I don't think there's many projects today that are going to withstand a shock of 5, 6, 7% interest rates. So you have to look through the world in kind of a reasonable lens and say, what is a 1 to 2 standard deviation move going to do to our project? If you think that there's a 5 standard deviation move coming, just hide your head in the sand and stay in cash, because there aren't too many investments that are going to withstand that kind of shock to the market. And the other thing is cap rates. What are current cap rates and what is your exit cap rate? And all too many times people play the game of, look, current cap rates today are 4% and we're going to exit at 3.5%. Every model works if you have declining cap rates. But since the risk is in expanding cap rates, what we do is we look at the prevailing market cap rate, and then we put an inflation factor on that cap rate each and every year for our exit strategy, right, or our exit cap rate. So if they're 4 today, we're going to increase that by about 10 basis points per year so that our exit cap rate is 4.5%. So deals that can handle up to that scrutiny are the ones that pass that first test. There's also, there's the kick the tire, good real estate, things like that. You don't just want this to be an Excel model discussion, but those are some of the little things that we do when we're thinking about risk management, because my background, I've seen a lot of this. I was an interest rate trader, so I've seen interest rates go kind of crazy. I understand. I studied a lot of the firms, going back to 06, 7, and 8. I was in graduate school watching a lot of these firms implode, and just a student of saying, why did they implode? What did they do wrong? And it's never about the real estate. It's generally about risk management policies that weren't sound. They weren't in place. They weren't thinking about the future, about how these things impacted them. So this is also a reason why we've never been a volume shop. And unfortunately, like the modeling I just talked to you about, when we were doing this in 2018, when we had a rising rate environment, we did 3 deals that year. We didn't do a lot of deals because nothing could stand up to our model. So I would just say, like, for investors, when they're comparing an IRR of 2 deals and they're looking at this, right, growth rates, make sure those are reasonable. Make sure that there's some sort of inflation to the interest rate side, so that you're, when you get through the development phase, that you're going into the permanent debt with a reasonable interest rate. And then make sure you're drifting cap rates as well.
Excellent. That's fantastic advice. Well, just one quick question to wrap up. I saw your article in the Wall Street Journal about you improving your home during the pandemic. I think so many people did that. But you mentioned early on that you had that background in construction. What lessons did you take from that experience, kind of coming full circle on that?
Oh, well, that was, I had a lot of time on my hands at home. And I think that when you find yourself at home, you start to see all the imperfections and the projects and things like that. And so I needed to keep busy, and I've always been somebody who's been good with tools, and ever since, not only when I was young, but even taking shop class, I've always enjoyed working with my hands and doing projects, and from a young age, I guess because I can. And so I did some fun projects. I built a baseball cage for my kids up top on our roof. I built a Murphy bed for my son. I put in new windows. And it's just been fantastic. But the physical side of, kind of doing, there's a satisfaction in it. So I enjoyed that during COVID. Some of the projects still need a little bit, more to complete, which my wife is talking to me about every day about getting those done. So, but I lost a little steam. They're 90% there. But one thing I don't like to do is paint and fill. So that's kind of where I end. I'm sort of a rough carpenter and trim carpenter.
I love that. Well, thank you so much for your time today, Michael. Reminder to listeners, you can learn more at origininvestments.com. Like he said, there's lots of good information there to learn about and understand really what they do. Remember, you can always email us at media@millionacres.com to share your thoughts. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Millionacres or The Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.